One of the biggest struggles when you're upgrading a home is actually financing the transitional period. Out of convenience, most people would want to sell their house first and then buy the new one. In theory, it makes sense and it sounds easy. However, it often doesn't work out that way because the bank don't want to finance that position because it's risky. What's going on, everybody? It's Blandon here from Mortgage HQ. This is fourth part to our 5-part series on selling your home to upgrade to a new one. In this video, we're going to explore the topic of bridging finance. Firstly, we're going to explore what is a bridging finance and why do we need it. Secondly, what types of bridging finances are there. Thirdly, what kind of bridging finance you need to avoid. And finally, how to make the most of bridging finance. So why do you need a bridging finance in the first place? More often than not, people need this because of a servicing issue. They might not have enough borrowing capacity to actually borrow the new money that they need for the new home and keep the existing debt on the existing home. Simply put, just can't borrow enough money. In other cases, it's because there isn't enough equity or deposit to keep into the two properties that you might be keeping. So if there's not enough equity to keep both, you'll need bridging finance to facilitate the sale of the existing home and buy the new home. So what are the different types of bridging finance? There are just two types. One we call open and the other one we call closed. So how can you remember this? Now, when you're buying and you're selling, there are two contracts. One for buying the new property and one for selling your existing property. A closed bridge means both of these contracts, selling your property and buying the new one, are both unconditional. Therefore, both deals are closed. Open, on the other hand, means one of these contracts have not been signed yet, and you're wanting the finance to buy the new one before you can sell yours. So again, closed bridge means both contracts are closed, and open bridge means one of the contract is still open. And for the latter, open bridge finance, is actually quite hard to get financing for. So why do the banks turn down open bridge finance? There are actually a lot of risk in an open bridge situation. Now, what might those be? Let's say if the bank lends you the money to buy the new property and you're actually unable to sell your existing home, you'll end up with way more mortgage than you can afford. This will put you in a pretty tough financial position, I would say. The other situation is that you can't sell the existing property for the amount that you anticipated for. So now the bank's capital position is a lot less than expected, and it's a way riskier position for the bank because they need to keep that 80% LVR rule or 60% for investments. And remember, in an open bridge, usually they're trying to finance almost 100% of the purchase price of the new property. Their capital is significantly lower in that position. And even a lot of second-tier banks want to avoid this. If they do take it on though, they're going to charge you in the vicinity of 12% plus or more. Open bridge finance usually only makes sense for investments that are significantly undervalued and you might need to do a quick deal, and are not recommended for owner-occupied upgrades. And sometimes I do get the whole, hey, I'm an existing client, the bank should do me a favor. Unfortunately, it's a really risky position for the banks to take on, and there isn't much money in it for them. So that leaves us with the closed bridges. How then do we make the most of the closed bridging finance? If you were to sell your existing home, then buy the new one, it's definitely going to be hard work. Since you might not find a new house in time, and you'll end up in a rental for ages with your family, and it's going to be pretty hard because you'll have to move all your stuff from this house and then that house and that house and then that house, and your partner or your spouse is just not going to be very happy. And even if you did find something in time, it's usually quite hard to align both of the settlement dates, like settling the property that you sold and align it with the same day as the one that you're buying. This makes house moving just a little bit trickier. Now, closed bridge works best if you have both contracts sorted quickly. Otherwise, if you want success in a closed bridge, then this one important thing you need to pay attention to, and that is negotiating a long settlement date. Now, a lot of people think maybe 40 to 60 days is a long settlement. Often we do deals where it's 5, 6, 12-month settlements. That's a long settlement date. So potentially you might want to consider selling to someone that is less time sensitive to move into a new home. Maybe you'll sell it for less, however, that is going to give you all of the time to find a new property. And that could be a lot more advantageous, because if you had to buy in a hurry, you might end up overpaying. Or vice versa, if the property that you're buying has a very long settlement date, that will allow you sufficient time to actually sell yours. Do this, however, with a lot of caution. You always want to have the backup plan in case you can't sell in time. And of course, if you're going unconditional on anything, I ask that you seek independent legal advice. Lastly, deposit. Don't forget, if you were to buy a new property, you'll need to put down at least 5% on the new property. If you're in an open bridge situation where one of the contract is not sold or one of the contract is not signed yet, the bank is not likely going to give you an overdraft for that deposit. So it's very important to note that you have some cash or revolving credit facility available. In a closed bridge, however, you do get access to that deposit, but you'll need that approval first. As always, if you're needing a bit of support in that area, just reach out to support@mhq.co.nz. One of our advisors will sort of walk you through those processes, probably a bit more in line with your current situation. And there you have it, folks. Hopefully you guys got a much better understanding on bridging finance. If you have found value, do not forget to smash the like button for the YouTube algorithm. And just a reminder, bridging finance is actually a lot more work, way more than what is needed than a normal new purchase loan or a refinance. So try and be nice to your banker or broker, whoever is helping you, because often it's a less popular loan. And stay tuned for part 5 to the series. Hit the notification bell, hit the subscribe button. I'll see you guys in the next video.